Thanks, Tim, and thanks to ShareCafe for the opportunity. Hopefully, given we've put a fair bit of information out to the market, especially this week, there's probably a fair bit to talk about, but within the 10 minutes, I'll skip through pretty quickly and hopefully trust that the market has had a fair bit of information from Ramelius in recent times. So if you go to that summary page there, 806 million shares on issue. That signifies completion of the friendly takeover of Spectrum. So all the shares associated with that takeover have been completed. Puts us at about 1.6 billion market cap, as you said, and with a very nice balance sheet of $161 million of net cash. And as we've grown over the last few years, I've got a share price graph coming up shortly. You can see that we picked up increasing amounts of broker coverage, including Shaw and Partners in recent times. Experienced board, but a lean board, an experienced and stable management team. A lot of the names there have been with the company for a minimum of 3 or 4 years, some up and beyond 10 years. Next slide, please. So just recapping on where our operations are, we're obviously a WA gold miner. We have a production centre or a trucking-based model, if you like, centred around the Mount Magnet gold mine, north of Perth, and the Edna May gold mine halfway between Perth and Kalgoorlie. We supplement operations at those processing facilities with generally higher grade satellite ore sources. And the most recent one referred to on this slide is the Penny Gold Project. We launched announced a bid in early February. We were able to achieve 90% ownership in less than 3 months, and ultimately at 100% late June. So within 5 months, we're able to complete that transaction. It's very much in line with our strategy of acquiring quality assets within trucking radius, and that trucking radius is typically up to 300 kilometres. The Penny project just looked and felt and smelt, being high grade, high margin, like a Ramelius asset. We felt that we needed to own it. We can truck it into Mount Magnet, some 160 kilometres to the north. It adds obviously to our mineral resources and adds to our mine life at Mount Magnet. And importantly, as you'll see, lowers the overall cost of not only Mount Magnet, but the Ramelius business quite significantly. Next slide, please. And you can see some of those assets on that map that we've acquired since 2014, and generally they've been asset purchases, but in more recent times, we've delved into the corporate world, and we've had 2 corporate takeovers as well with Explore and Spectrum, and you can see the growth. And I've had other slides that have shown that every one of these acquisitions has returned positive cash flow and has been a net return, and that's one of the things that we pride ourselves on. We buy assets that we believe we can make a return on. Next slide, please. On Wednesday, we put out our Q4 production, and as evidenced by this graph, it's been a knock it out of the park quarter, considering we've gone from 50-odd thousand ounces to over 85,000 ounces in the quarter, and it's been due to outperformance at both Edna May and Mount Magnet, particularly Mount Magnet, with our Shannon Underground and our Eridanus open pit, which we'll touch on a little later, continuing to outperform. It's led to a record year of 230,000 ounces, and it continues a growth path that we've had over since 2014, when we were producing closer to 85,000 ounces. And that growth is another 20% growth next year when you look at our full year guidance for FY21 of 260 to 280,000 ounces at an average of around $1,270 an ounce Australian. And what you're seeing now, particularly in Q4, is the benefit of capital spent in the first half of the year. That capital starts to come off in the second half, and it's really leading to some serious cash generation within the business, evidenced by what's happened in Q4. And our exploration will be restarting as we've reduced our footprint in the Q4, obviously in response to COVID, like a lot of our peers. Next slide, please. Here's our life of mine plan we put out on Tuesday. It builds on the life of mine plan we put out 12 months earlier, which was just over 1 million ounces. Now we're up to 1.45 million ounces, a 34% growth. Going from strength to strength, we're looking to be above 250,000 ounces for the best part of 5 to 6 years, with a couple of years of tail on the end of that. We have a track record of delivering on our guidance, something I'm very proud of, and I know the operations teams are as well. 26 out of the last 28 quarters or something like that. And then we have the Penny Gold project commencing in late FY22. And if you look at the graph, you've got Mount Magnet in yellow, Edna May in blue, and Penny in the darker yellow, obviously being associated with Mount Magnet. And we'll be looking to do what we can to pull that start date of production at Penny forward, if at all possible. And you can see that would have a significant positive impact on production in FY22 and continue us on that growth path towards 300,000 ounces. Next slide, please. And we've also provided, along with those production outlines by production centre, a full suite of numbers, all-in sustaining cost ranges, capital, which is the upfront capital for the capital not included in the all-in sustaining cost, and largely accommodates projects such as Eridanus open pit and Eridanus underground, Tampia, which is south of Edna May, and the Penny project, which I'll come to in a little detail later. And we've also put in exploration next year, a little higher than historically, which has been around $20 million a year. We think that's justified simply by virtue of the fact that the Penny ground is highly prospective, and we'll be looking to spend some additional money there this year. Next slide, please. This is probably the best slide in the pack, or the most interesting one for me. The yellow shows the life of mine plan 12 months ago. The green shows this year's life of mine plan, and you can see quite clearly that we produce at a higher rate for longer. So we've had a very busy and successful 12 months. And at the end of the pack, I've also got what we'll be doing to further extend that in 12 months' time. So the 34% growth, as I've touched on, has been primarily driven by Eridanus, both underground and open pit, and then the new Penny project, which is a very high-grade, high-margin project. Next slide, please. I won't go into details on the two production centres, but just to summarise Mount Magnet, it keeps on delivering. This is a classic old-style mining camp, West Australian mining camp. It's been mined on and off for 100 years, 6 million ounces and counting, but it keeps on delivering. We're finding new ore bodies, 3 or 4 k's from the mill. So this is by no means done. We think that there's a lot of mining to be done at Mount Magnet going forward. We've got a very well-run, competitive operating cost plant, partly due to the fact that it's run off gas-fired power, and the fact that we've been operating it now for 8 years and really had that thing operating very well. Next slide, please. Whereas down at Edna May, we have a much larger tract of land, and we are in a different operating scenario. Rather than a 5 kilometre by 5 kilometre tract of land at Mount Magnet, here we've got, for example, between Edna May and Hollerton, which is south of Symes Find, at the very bottom of the map, we've got 130 kilometres. We do need larger tracts of land in this area because in that part of the world we are on farmland, so we don't get access for the full year. There's obviously wheat and barley crops to deal with, which we've just commenced seeding of that season right now, so we haven't got access all year round, but there's a lot of potential upside for projects to feed into the Edna May mill. Marda has just started to come in. Tampia to the south of Edna May will be in next year in FY22. Symes Find is in the later in the mine plan, and it's still being worked on. And again, we have a processing plant that we are running currently at 2.7 million tonnes. The costs are below $20 a tonne. We're fortunate that we're on the state grid power there. So again, that helps give us a leg up on lower costs for that mill. Next slide, please. And again, just on the Penny project, we're moving as quickly as we can. When you see the numbers in terms of the all-in sustaining costs, you'll understand why. One of Australia's highest grade gold mines, Penny will be. We have a 300,000 ounce initial resource, of which the primary part of it is the Penny North, which is the yellow ore body to the right. It's at 20 grams per tonne. And inside that, we've announced an initial or a maiden ore reserve of 230,000 ounces. So pretty decent conversion of resource to reserve at about 15 grams. And importantly, as I mentioned, we'll have the drill rigs back there looking for more Penny North and extensions to Penny North, and indeed the historic Penny West, which is the one shown in purple. Next slide, please. Pre-feasibility, pretty compelling results for a $23.5 million upfront capex. We've got a project here that will operate at just over $700 an ounce. At current spot prices, that's $1,800 an ounce margin. You start to put 230,000 ounces of production in there, and you can see some pretty serious cash flow. On the right-hand side, we have the cutback of the Penny West pit, and then the decline that'll access the top of the Penny North ore body. You can see there. Next slide, please. Eridanus is our, as I mentioned, our third largest endowment area at Mount Magnet, after Hill 50 and Morning Star. Almost 500,000 ounces. 12 months or so ago, this didn't exist. It's covered by 20 metres of waste of cover. That it possibly explains why it wasn't discovered earlier. It sits between two old pits. So we've gone from having nothing there to having a 230,000 ounce pit, and also underground potential, which we've included in the back end of the plan. And the ore body seems to be getting wider, more consistent and higher grade with depth, which is obviously very exciting for the team up at Mount Magnet. Next slide, please. And what we've found in the open pit, here's a picture of a plan view of the stage 1 pit. We've got these high grade veins inside this porphyry ore body, which has led to outperformance in terms of grade and also tons. You can see the photo of what those veins look like in the wall of the pit. We're remodeling to ideally get a higher grade. We're confident that that will happen, but in the meantime, we've put in preliminary numbers into the back end of our mine plan. This is 2025, 2026, of relatively low grade bulk underground that we think will only improve with further modelling and further drilling. Next slide, please. And next one. And just to finish off, processing studies. People ask me a lot, you know, how much more of your extensive resource base at Mount Magnet can convert at higher prices. And it's fair to say that there's been a number of resources there on the shopping list of resources at Mount Magnet that haven't been looked at for some time, and potentially have only been looked at since the gold prices were $1,600, $1,800 an ounce. So we'll spend the next 6 to 12 months looking at the plethora of resources there at Galaxy, at Morning Star, and then at the newer areas, Eridanus, Shannon and Stella. And separate to that, we'll look at what it'll cost us and what the cost benefit analysis is for an expansion of the current 2 million tonne per annum plant up to 2.4, noting that it was run at 2.4 several years ago, and the infrastructure is, whilst it's been dormant, it's still in place, and it's something that we think we can carry out for less than $20 million. Down at Edna May, we'll look at expanding our underground operation, which is effectively focused on the high-grade veins inside the Edna May ore body, to see whether a bulk option of that underground is preferable, or indeed the stage 3 pit, which has the potential to add significant ounces and life to the Edna May operation. Next slide, thanks. And that's all I have. Thanks for your attention.
Thanks, Mark. We've got a number of questions around your hedging policy. Can you give us a little bit more detail on that, please?
Our hedging policy is broadly, we target to have 1 year hedged over the next 3 years. And typically that would be on average about 40% of that profile. At the moment, given our profile of increased production, it's probably closer to 30%. And it's obviously more front-ended. You know, you may have 50% in the first year, sort of 30% in the second year, and as low as sort of 10% in the third year. One of the things about hedging that I don't think has been talked about much is the fact that the gold market is in backwardation. The further you go out, you'll get a lower price than you would today, which is not something historically you see with the gold market. Normally it's in contango and you can get a better price as you go out. And I think people need to understand that. It's not as simple as going out 3 years and putting on $3,000 an ounce hedges. It doesn't quite work like that at the moment, even though it may have in the past.
Yeah, good answer. And what about dividend policy?
Yeah, we paid our maiden dividend last year, and our policy is a minimum of 1 cent, which is what we paid last October, up to a maximum of 30% of free cash flow. Obviously, with our cash generation this year, we're very well positioned. It's obviously a discussion the board will have in due course, but we're in a nice place for that. That's for sure.
And what about acquisitions too? That's been part of your timeline in the past.
Yeah, we've targeted 300,000 ounces production plus. We figured that needed 3 production centres at about 100,000 ounces per year each. So we have 2. So we're always on the lookout for a potential third asset. We make no secrets about that, but we're not in a hurry. It needs to fit our profile. It needs to ideally be an upgrade on what we have in terms of life and cost and perception in the market. So we'll take our time to fill out that third asset if and when it happens.